The universal retirement goal usually looks like one of two things: reaching a $1 million portfolio or generating roughly $4,000 a month in passive income. Yet the average American family ends their career with around $334,000 saved for retirement. This chart shows what that reality buys. Applying a 4% safe withdrawal rate to that average savings yields only $13,000 a year. That pays for groceries. It won't replace a paycheck. That empty space between $334,000 and the $1 million target is the strategy void. Most investors fall into this void by selecting the right fund for the wrong goal, specifically attempting to extract wealth with tools meant for accumulation. Failing to explicitly align an investment strategy with a specific timeline guarantees you will either run out of money or wait 30 years for income you needed in 10. 3 variables dictate every portfolio success: time, capital input, and risk. These factors exist in a rigid mathematical relationship, where decreasing one forces a dramatic increase in the others. To engineer a portfolio by deadline, you must dictate your strategy by exactly when that money must be ready for use. We are going to map 3 exact mathematical blueprints for 3 distinct scenarios based on your primary constraints. The goal is to find the specific mathematical equation that fits your current reality. Scenario A serves individuals in their 20s or 30s who possess minimal daily capital but a massive time horizon. Reaching the goal on this timeline requires just $6 a day, directed into a mix of broad market and growth funds. This allocation anchors heavily in the S&P 500 for stability, with smaller positions in the NASDAQ and semiconductors to push the ceiling higher. This low-input portfolio is projected to cross the $1 million threshold at the end of a 30-year window. Over those 3 decades, you personally contribute only $65,700. The remaining $938,000 is the result of time in the market. The challenge is psychological. Early progress feels completely invisible, and your dividend income will be negligible for the first 15 years. This path succeeds by replacing high capital requirements with sheer patience, letting decades of compounding do the heavy lifting. Scenario B, the 10-year accelerator, serves those in their 40s or 50s who need to urgently compress their timeline to retirement. Making this math work requires a dramatic jump in capital density, escalating from $6 a day to $120 a day. You also have to pivot to extreme risk concentration, placing 50% of the portfolio in the semiconductor sector to hit the growth targets. Semiconductor stocks are notoriously cyclical, exposing the portfolio to massive sudden drawdowns. Holding concentrated tech assets through a market crash requires the resolve to watch your balance drop 30 or 40% without panic selling. You can buy back a decade of time, but the price is paid through either massive daily cash contributions or by enduring extreme portfolio volatility. Scenario C, the wealth extractor, is for retirees or those pursuing FIRE who require usable cash to pay bills today. This requires moving capital entirely away from pure growth and into covered calls, REITs, or dividend ETFs like SCHD. This high-yield reallocation drastically accelerates usable monthly cash flow, reaching that $4,000 monthly target much sooner than a growth-based approach. However, this strategy carries an invisible mathematical penalty. You surrender maximum long-term portfolio appreciation in exchange for immediate payouts. To see the scale of that cost, we can compare a $100,000 investment in a pure growth S&P 500 ETF against a pure dividend ETF over 30 years. The data shows that choosing the pure dividend strategy early on costs you roughly $1 million in total portfolio valuation over 3 decades. Optimizing for a reliable monthly paycheck permanently caps your maximum wealth ceiling to secure psychological peace of mind. One structural wrapper can alter the math for all 3 scenarios: the Roth IRA. In a Roth IRA, capital is taxed before it enters the account, rather than as it grows. This structure shields decades of price growth and reinvested dividend income entirely from the drag of yearly taxes. The trade-off for this tax-free environment is a lack of liquidity. Capital is locked away until age 59 and a half. Frequent trading or attempting to time the market inside a Roth defeats its primary advantage: uninterrupted compounding. A Roth IRA is the ultimate engine for any timeline, provided your constraints allow you to lock that wealth away until retirement. To find your starting point, you must identify your primary constraint: time or capital. If you are capital constrained, ignore high yields for now. Build a broad market base with VTI or VOO and leverage your decades of time. If you are time constrained and pursuing $1 million balance, you must accept extreme tech volatility or drastically increase your daily contributions. If you need cash immediately, pivot your strategy to SCHD or covered calls and stop optimizing for total portfolio value. No single ETF combination will serve all three of these goals simultaneously. Financial freedom requires you to ruthlessly align your asset allocation with your specific mathematical reality.